All right, let's talk about one of the most important and, yeah, controversial innovations in the entire crypto world, stablecoins. Now, these things were created to solve a huge problem with digital money, but as we're about to see, they bring a whole new set of fascinating risks to the table. Okay, let's get into it.
So, first off, why do we even need stablecoins in the first place? Well, just imagine you get paid, say, $100 in a typical crypto. You go to bed feeling good, but when you wake up, its value has just plummeted, and now you only have $70. That kind of volatility is maybe exciting for traders, but it makes crypto almost impossible to use for everyday stuff, like paying your rent or just saving up.
And that, right there, that's the exact problem stablecoins were built to solve. They're meant to be a kind of bridge, giving you all the cool stuff about blockchain, like the speed and global reach, but without those wild, heart-stopping price swings. Think of them as the calm in the middle of the crypto storm.
So what is a stablecoin, really? It's a special type of crypto that's engineered to hold a steady value. The most common goal is a simple one-to-one peg with a major currency, so one stablecoin is always supposed to equal $1. The whole point is just no surprises.
But how in the world do they pull this off? Well, it's not magic, it's all about the mechanics. And generally, stablecoins come in 3 main flavors, and each one has a totally different way of keeping its price stable. Let's break them down.
First up, we've got the most common kind, fiat-backed. The idea here is actually incredibly simple. You go to a company, you give them $1, and in return, they mint and give you one of their stablecoins. That coin is basically just a digital receipt, a claim check for that real dollar they're holding in a bank account. You can send that coin all over the world, and whenever you want your dollar back, you just redeem it. Simple as that.
Now, the second flavor is crypto-backed. And right away, this probably sounds a little weird, right? How can you possibly create a stable asset when you're using other volatile cryptocurrencies like Ether to back it up? It seems like a total contradiction.
Well, the secret ingredient here is a concept called overcollateralization. Here's how it works. To get, say, $100 worth of a crypto-backed stablecoin, you have to lock up more than $100 of another crypto. For example, maybe $150 worth of Ether. That extra $50 acts as a safety buffer. It's like an insurance policy, making sure the system stays stable even if the price of that Ether collateral takes a dive.
And that brings us to our third, and by far the most controversial type, algorithmic stablecoins. Now, these are wild. They don't have any real-world assets backing them up. No dollars, no crypto, nothing. Instead, they use these really complex algorithms and code to automatically manage the coin's supply. It's kind of like a smart thermostat for money, constantly tweaking things to keep the price at exactly $1.
The most famous, or maybe infamous, example of this was a coin called Terra USD, or UST. Its algorithm was designed to keep that $1 peg by working in tandem with a sister token called Luna. The idea was actually pretty clever. If UST's price ever dipped below $1, traders could buy it cheap, swap it for exactly $1 worth of newly created Luna, and make a tiny profit. That buying was supposed to automatically push UST's price right back up to $1.
But the entire system, this whole complicated dance, it all depended on one critical thing: confidence from the market. And in May of 2022, that confidence just shattered. A huge wave of selling hit, people rushed for the exits all at once, and the algorithm that was supposed to be the smart thermostat basically entered what's known as a death spiral. It just couldn't print its sister token fast enough to handle all the selling.
And the result? Well, it was absolutely catastrophic. A token that was supposed to be worth exactly $1 collapsed, with its value plummeting to less than a penny. It was a failure that wiped out billions of dollars and became this huge warning about the dangers of these purely algorithmic designs.
So, let's just put this all together so you can see it side by side. There's a really clear trade-off here. Fiat-backed coins, super simple, easy to get your head around, but you have to trust a single company to actually have the money. Then you have the decentralized options, crypto-backed and algorithmic. They get rid of that single point of failure, but they introduce totally new kinds of risk, like being vulnerable to a market crash or, as we just saw, a complete meltdown of the algorithm itself.
And this gets to a really crucial point. Despite that name, stablecoin, none of these are completely free of risk. It is so important to understand that not all stablecoins are built the same, and each type comes with its own unique set of dangers you need to know about.
So, what are the big risks you need to watch out for? Well, for the fiat-backed ones, it's all about reserve risk. Does that company really have $1 in the bank for every single coin out there? For crypto-backed, it's collateral risk. What happens if a massive market crash blows right past that safety buffer? For algorithmic ones, the risk is a total algorithm failure. And then on top of all that, you have smart contract risk, bugs in the code that could be hacked, and, of course, regulatory risk, where a government could just decide to change the rules of the game overnight.
You know, these risks are exactly why the debate around stablecoins is so intense right now. And it's not happening in a vacuum. There's a brand new, very powerful competitor showing up on the horizon, and it's coming directly from the very institutions that stablecoins were trying to get away from.
And that new competition is central bank digital currencies, or CBDCs. What are they? Well, they're basically official digital dollars, or digital euros, or digital yuan, all issued and controlled directly by a country's central bank. You can think of it as the government's answer to private stablecoins.
So what's the real difference here? Well, stablecoins, as we know, are put out by private companies, and their control can range from centralized to decentralized. CBDCs, on the other hand, are issued directly by the government, which means control is completely centralized. And as you can imagine, this brings up some pretty big questions around things like privacy, which is almost certainly going to be lower with a government-run digital currency.
So after all that, what's the big takeaway for you? If you're going to use stablecoins, you have to be smart about it. First, stick with the big, well-known projects that get regular audits. That transparency is everything. Second, always understand how your stablecoin is actually backed. Is it cash in a bank? Is it a pile of other crypto? Or is it just code? Third, don't put all your eggs in one basket. And finally, please be incredibly cautious with any of those experimental models, especially the purely algorithmic ones. The risk can be off the charts.
And that really leaves us with this huge, fascinating question for the future. As we move deeper and deeper into a digital financial world, what are we ultimately going to put our trust in? Will it be the innovation of private companies and decentralized code, or will it be the stability and authority of government-backed public policy? The answer to that question, well, it's going to define the future of money for all of us.